So, when you're thinking about making an investment, maybe putting money into a new business or even just dedicating serious time to a big personal project.
Yeah, absolutely.
And you always hit that fundamental question, don't you? What return should I really expect for the risk I'm taking on here?
Exactly. It's a core challenge. You want to move past just guessing, right? You need a systematic way to figure out the return you actually need to make it worthwhile given the uncertainty.
And that kind of strategic thinking, that quantification, is exactly what we're diving into today. We're tackling the capital asset pricing model, or, CAPM.
Oh, yes, CAPM,
Yeah.
a real cornerstone in finance.
Definitely. So our mission today is to unpack what CAPM really is, how it helps estimate that required return based on risk, and specifically look at how you use it to calculate things like the cost of equity or even a discount rate for a specific project. We've been digging through some detailed financial guides to pull out the key ideas for you.
And hopefully you'll have some aha moments. We're going to try and demystify risk a bit, look at the crucial variables, and see how these concepts actually play out in, real world decisions.
Okay, so let's jump in. The core idea of CAPM starts pretty simply, right? Every investment has risks.
Always. The return you actually get might be different from what you hoped for or expected, sometimes very different.
And because people don't generally like risk, certainly not for free.
Right. Investors demand compensation for taking it on. And CAPM is basically a method, a model for calculating what that required return should be based on assessing the investment's risk.
Now, risk in finance, it's not all the same, is it? There's a really important distinction to make here.
Yeah, that's crucial. Think about diversification. If you invest in lots of different companies, different sectors.
Spreading your bets, basically.
Exactly. That diversification can really help reduce the overall risk in your portfolio. But, and this is the key thing, it doesn't get rid of all the risk.
Okay, so let's break that down. The risk you can get rid of, or at least minimize, by diversifying, that's called unsystematic risk.
Or sometimes diversifiable risk or specific risk. It's the stuff that's unique to one company, like a product failing or a change in management, that kind of thing.
Right. If you own enough different stocks, one company having a bad run doesn't necessarily sink your whole portfolio.
But then there's the risk you can't diversify away no matter how many stocks you hold. That's systematic risk.
Also called undiversifiable risk or market risk.
Precisely. This is tied to the whole economy, the whole financial system. Things like, interest rate changes, inflation, recessions, stuff that affects almost everyone.
And here's where CAPM makes a really big and quite powerful assumption. It assumes investors are smart enough to hold fully diversified portfolios.
Yeah, that's a fundamental assumption.
Which means CAPM focuses only on systematic risk when figuring out the required return. The logic is, why should the market compensate you for taking unsystematic risk when you could have just diversified it away yourself?
Exactly. You only get compensated for the risk. You can't avoid the systematic market-wide risk. It simplifies things massively.
It really does. And the measure for this systematic risk within the CAPM framework, that's beta, isn't it?
That's the one. Beta.
So speaking of beta, let's actually look at the CAPM formula. It's written as EA, RF plus by E, RM, RF.
Looks a bit mathematical, maybe.
A little. But let's unpack each piece, because each one tells part of the risk and return story.
Okay. So first up, EHR. That's your expected return or the required return on whatever financial asset you're looking at. If it's company shares, this is basically the cost of equity.
Got it. Then RF, that's the risk-free rate of return.
Right. The sort of theoretical return you'd get on an investment with absolutely zero risk.
Which doesn't really exist in the real world, does it?
Not truly, no. But we use a proxy, usually short-term government debt, like UK Treasury bills if you're looking at the UK market.
Yeah.
And it's the yield on those bills we're interested, not just a stated interest rate.
And that RV rate isn't static? It changes, depending on the country, the economy.
Absolutely. It moves around. Okay, next bit. The part in the brackets, ERMRF. This is super important.
Right. ERM is the expected return on the overall market.
But what researchers really focus on is the difference between that market return and the risk-free rate. That difference, ERM minus RF, is called the equity risk premium.
Okay, so it's the extra return investors demand for taking on the risk of investing in the general stock market compared to just sticking with that safe, risk-free asset.
Precisely. It's the premium for bearing systematic risk. And often, to get a stable number, analysts look at long-term averages, maybe smoothing it out over decades.
And for the UK market right now, that premium is typically estimated somewhere between, 3.5% and 4.8%.
Yeah, around that range, based on current research. Okay, last piece. Beta, the beta value.
The measure of systematic risk we mentioned earlier.
Exactly. Beta tells you how sensitive a particular asset's returns are to the movements of the overall market. It compares the asset's systematic risk to the market's systematic risk.
So a beta of 1 means same risk as the market.
Pretty much. If the market goes up 10%, a stock with a beta of 1 is expected to go up around 10% too, on average, of course.
And less than 1, like 0.5.
Less sensitive. A beta of 0.5 suggests it might only go up 5% if the market rises 10%.
Yeah.
Think maybe utility companies, sometimes less volatile.
And higher than 1, say 1.2.
More sensitive, more volatile. A 10% market jump might mean a 12% jump for that stock. Maybe, tech stocks sometimes fall into this category.
And importantly, you don't usually have to calculate these betas yourself from scratch, right?
Yeah.
Financial data providers track this stuff.
Oh, yeah. Places like Bloomberg, Refinitiv, London Business School Risk Management Service. They publish beta values for listed companies. It's readily available data.
And if you plot this whole CAPM formula on a graph,
you get a straight line. That's the security market line, the SML. It shows the relationship visually. Higher beta, higher required return.
It's a neat way to see it. Risk on one axis, required return on the other.
Ties it all together.
Okay, so theory is one thing. How does this actually work in practice? This is where it gets really interesting, I think, applying it. Let's take a simple case, calculating a company's cost of equity.
Right. Let's use an example. Say we have Remco. We know the risk-free rate, RF, is 4%. We know the equity risk premium, ERM-RF, is 5%. And we look up Remco's beta and find it's 1.2.
Okay, so we plug those into the formula, EBRF plus beta's RMRF. That's 4% plus 1.2 times 5%.
Exactly. So 1.2 times 5% is 6%. Add that to the 4% risk-free rate.
And we get 10%.
We get 10%. So EAPM tells us that the required return for Remco shareholders, its cost of equity, is 10%. That's the minimum return the company needs to generate to compensate its equity investors for the systematic risk they're taking, given its beta of 1.2.
That seems surprisingly straightforward once you have the numbers.
When you have the inputs, the calculation itself is simple, yeah. The tricky part is often getting reliable inputs, especially the equity risk premium and the beta.
Right. Okay, but let's push this further. What happens if Remco, or any company, decides to invest in a project that's totally different from its usual business? Yeah. Can it just use that 10% cost of equity we just calculated?
Good question. And that leads us into a slightly deeper discussion about betas. Yeah. Because there isn't just one beta. We need to think about asset betas versus equity betas.
And debt betas too, right?
Yeah, and debt betas, yes. This distinction is key when we consider a company's business risk versus its financial risk.
Explain that difference, business risk versus financial risk.
Okay. So business risk is the risk inherent in the company's operations, its industry, its market position, regardless of how it's financed. Financial risk comes from the company's use of debt. It's gearing.
Gearing, that's just the amount of debt relative to equity, right?
Exactly, how leveraged the company is. Now imagine a company with absolutely no debt, all equity financed.
Okay.
Its beta reflects only its business risk. We call this the asset beta. And as long as its basic operations don't change, that asset beta should stay pretty constant.
And for that no debt company, its asset beta and its equity beta would be the same thing.
Precisely. But as soon as a company takes on debt,
things change.
Things change. The debt introduces financial risk. The shareholders now bear not only the business risk, but also this added financial risk because debt payments have to be made before shareholders get anything.
So they demand a higher return to compensate for that extra layer of risk.
Exactly. And that's reflected in the equity beta. Mm-hmm. The equity beta captures both business risk and financial risk. So as a company takes on more debt, increases its gearing, its equity beta tends to go up.
Even if the underlying business hasn't changed.
Even if the underlying business risk, the asset beta, hasn't changed. The asset beta is kind of like the weighted average of the equity beta and the debt beta, weighted by their market values, adjusted for tax. There's a formula that links them all.
Okay, let's make that concrete. An example.
Sure. Let's take Tugco. Suppose its equity beta is 1.2. Its debt beta is very low, let's say 0.1. Market value of its shares is $6 million. Market value of its debt is $1.5 million. And the tax rate is 25%.
Right, so first we need the total value, but adjusted for tax on the debt part.
Correct. The after-tax market value of the company. It's the equity value, 6 metals, plus the debt value after tax, 0.5 meters, 1.25 meters. So $1 allowed 755 equals $1, 125 meters.
Okay, so 6 meters plus 1.125 meters gives 7.125 meters total value for weighting.
Perfect. Now the asset beta is the weighted average. Equity beta, equity weight plus debt beta debt weight. So beta, you have 1.125 meters plus 1.4 meters, 1.25, 7.125 meter. Note we use the after-tax value of debt in the denominator and the weight calculation reflecting the tax shield.
Let's see, 1.26, 7.125 is about 1.014, and 0.1.1.75, 7.125 is about 0.016.
Add them together.
You get roughly 1.123. Oh, wait, let me recheck the text. The formula shown uses the after-tax weight of debt in the numerator, too. Okay, so 1.2 by 6, 7.125, plus 0.1 by 1.5 by 0.75, 7.125.
Right. The weightings need to sum to 1 based on the total value. So 7.2, 7.125 plus 0.1125, 7.125. First term is 1.0105. Second is 1.0158.
Giving us 1.026. The original example calculation was 1.024. Slight rounding difference, perhaps, but the point is the asset beta is lower than the equity beta.
Exactly. It shows we've stripped out the effect of the gearing, the financial risk, to get closer to the pure business risk inherent in Tugco's operations. That 1.024 represents the underlying risk of the business itself.
Okay, that makes sense. Which brings us back to my earlier question. If a company, say Ladco, is doing a project completely different from its main business.
Right, like our food processor going into coal mining.
Can it use its own overall company cost of capital or its own equity beta for that coal mining project?
And the answer is almost certainly no. It would be a mistake because the business risk of coal mining is likely very different from the business risk of food processing.
So using the company's average cost of capital could lead you to accept a risky project that doesn't offer enough return or reject a safe one that actually does.
Precisely. You need a discount rate that reflects the specific risk of that project.
Which means we need a project-specific discount rate. How do we get that using CAPM? Is there a process?
There is. It's a logical 6-step process, essentially.
Walk us through it. Step 1.
Step 1, find proxy companies. You need to identify publicly traded companies that are already operating in the same line of business as your proposed project.
So for the coal mining project, find existing coal mining companies.
Exactly. Their equity betas act as proxies for the kind of risk involved in that industry.
Step 2, get the proxy info. Collect data on these proxy companies, their equity betas, their gearing levels, debt equity structure, and their tax rates.
Step 3, ungear the proxy betas. This is crucial. Each proxy company's equity beta includes its financial risk. We need to remove that to isolate the underlying business risk, the asset beta.
Back to the asset beta formula, or a version of it. You mentioned simplifying by assuming debt beta is 0.
Yeah, that's a very common simplification. Debt betas are usually tiny, and the tax shield makes the debt component even less significant in the weighting. So, the simplified ungearing formula becomes asset beta, equity value plus debt value, 1 tax rate, or simply rectify O equal to phi plus VD1T.
So you give the calculation for each proxy company.
Yes. Ungear each one individually.
Step 4, average the asset betas. Now you've got several asset betas, probably slightly different. You average them usually just as simple mean, maybe chucking out any obvious outliers. This average asset beta represents the pure business risk of your project.
Step 5. Regear the average asset beta. Okay, now you take that project business risk, the average APIA, and you need to incorporate the financial risk profile of your company, the one making the investment. This is regearing.
So you're adding your company's specific financing mix back into the picture.
You essentially reverse the ungearing formula or use the regearing version. Regeared equity beta, average asset beta, 1 plus 1 tax rate, debt value, equity value. That's beta 1 plus 1 TVDD. This gives you an equity beta that reflects the project's business risk and your company's financial structure.
Okay, nearly there. Step 6.
Step 6. Calculate the project-specific cost of equity. You take this regeared equity beta, plug it back into the main CAPM formula along with the risk-free rate, RF, and the equity risk premium, ERMRF.
So ERI RF plus regear beta RM.
Exactly. And that E is your project-specific cost of equity, the discount rate you should use for evaluating that particular project.
Wow. Okay. That's quite a process. Can we run through an example?
Definitely. Let's use LADCO. LADCO wants to invest in a new project, different from its usual stuff. It plans to finance it using its standard structure, 30% debt, 70% equity. Its tax rate is 25%. The risk-free rate is 4%, and the equity risk premium is 6%.
And it found 3 proxy companies.
Yep, CUPCO, MUGCO, and JUGCO. We have their details.
Equity beta 0.81, 25% debt, 75% equity.
Equity beta 0.98, 40% debt, 60% equity.
Equity beta 1.16, 50% debt, 50% equity.
Okay. Step 3. Ungear each proxy's beta using beta is V plus VD1T and TT.25.
Right. For CUPCO, beta was 0.81, 75 plus 25 plus 0.25, weight 0.25 equals 21.75 plus 60.75, 93.75, 0.648.
Okay. For MUGCO, beta 0.98, 60 plus 40, 1.25, 0.98, 60 plus 30 is 50.8, 90 equals 0.653.
JUGCO beta was 1.1650 plus 50, 1.1650, 50 plus 50 plus 37.5 equals 0.655. So that's our project's business risk beta.
Correct. Now, step 5, regear this 0.655 using LADCO's financing, 30% debt, 70% 653 equals 0.655.
We use beta 0.655. Shear bushel base 1.655, 1 plus 1.25, 3070. That's 0.655, 1 plus 3.655, multiplied by 0.865, first 0.66, depending on round, was 0.866. That's the regeared equity beta for LADCO's project.
Okay. Final step, step 6, calculate the project's cost of equity using CAPM, EAR, RF plus ARM, RF.
So ERE equals 4% plus 0.8666%.
0.866 times 6 is 5.196. So 4% plus 5.196%.
It equals 9.196%. Let's round it to 9.2%.
So 9.2% is the project-specific discount rate for LADCO's new venture.
That's it. That's the rate LADCO should use to evaluate the cash flows from this specific project because it reflects the project's business risk combined with LADCO's own financial structure.
That makes so much more sense than just using a single company-wide rate for everything. It really tailors the hurdle rate to the actual risk being taken.
It does. It ensures you're applying the right risk premium. You're not asking too much of a low-risk project or too little of a high-risk one. It helps make much better capital allocation decisions.
We've covered a lot of ground here, from the basics of risk systematic versus unsystematic through the CAPM formula itself, calculating a simple cost of equity, and then this quite sophisticated process for finding a project-specific rate using proxies and ungearing and regearing betas.
It's a powerful toolkit. It moves the assessment of required return from pure guesswork towards a much more structured, data-driven approach, even if it relies on some assumptions.
Absolutely. So wrapping this up, we've seen how finance tries to precisely measure the return needed for a specific level of risk, particularly for big investment projects. It makes you think, doesn't it? How could applying a similar kind of risk-reward thinking change how you evaluate opportunities in your own life?
That's an interesting thought.
Yeah, I mean, from deciding where to invest your savings to even choosing which new skills are worth the effort to learn, what's the beta, the relative risk and potential payoff of your own personal or professional ventures? Something to ponder.